Hi, greetings everyone. So this is the second and the last lecture of chapter 8, which is use of derivatives. The first lecture was a live lecture that we had conducted, and this is the recorded one. Just move on to the index. We were done with financial futures options. Only the last bit with regards to interest rate and currency swaps that was left. So that is what we'll be covering. This is what we looked at: financial future agreements, type of difference between futures and forwards, type of financial futures as such, the four types mainly: bond futures, short interest rate future, stock index future, and currency future, along with the uses of all the four. Then we moved on to options, and we also saw the uses of options, and that's where we ended the lecture. Interest rate swaps is what, and currency swaps is what we need to look at. So, won't be a long lecture as such, just a short 30 minutes probably. So I'll just start off. So, by the word swap, okay, it is completely new to you. So I'll explain it from the basics. So swap, another word for swap is, I'll write here. Okay, yeah, swap is exchange. Okay, so whatever you have, you are exchanging it with what the other person has. So you are exchanging one thing with the another. Here, in case of a series of payments according to a pre-arranged formula. Okay, so you are exchanging a series of payments. Basically, you are trading. You are giving something and you are receiving something. You are giving one payment, you are receiving another payment, and there are series. So this is probably after 3 months. Again, this thing will happen. You will pay something, you will receive something. Another 3 months after another 3 months again. So paying and receiving will keep on happening after every 3 months, 6 months, or 1 year, whatever the periodicity is. That depends. But this is how it will work. They are mainly traded over the counter markets. Okay, in over the counter OTC markets, there is no exchange as such, which gets this OTC contracts. There are two legs in each of the swap agreement. There is a payer leg and there is a receiver leg. Because see, like I mentioned, you are paying something and you are receiving something, right? You are paying one amount, you are receiving another amount. Those two amounts are based. Sorry, I guess I cut out in between. I'm not sure from where. Some connectivity issue. Yeah, I'm sharing my screen. Okay. Okay. So yeah, I was looking at the legs of the swap. So one is the payer leg and one is the receiver leg. You pay something. This is pay, and in return you receive something. Those payments are based on a series of pre-arranged formula. That formula and everything we'll look at it. Okay, they are traded in OTC markets is what I mentioned. Also, now we will look at the present value of both legs is computed. Okay, so there are cash flows. Okay, from the pay leg there are cash flows. This is a pay leg cycle. There will be cash flows that you need to pay. Now, just below it, there will be a receive leg cycle, and these would be the cash flows that you would be receiving. Okay. Now, what we'll do is we'll get the PV, present value of this leg, and the present value of the above leg as well. And the difference between both the present value is the value of the swap. Okay, so you have the cash flows, right? You have all the cash flows. We will see how to get a discount rate. Even you can consider normal 5%, 6% discount rate based on which currency it is. You got the discount rate, and you just now divide the all the cash flows with the discount rate. So that will help you to get the present value. It's just normal discounting, how you discount bond cash flows. Similarly, you have to discount this cash flows as well. And if black is the pay leg, okay, this is pay, black is pay, and red is receive, then in that case, final NPV would be receive PV minus pay PV. Okay. If you are receiving, let's say, end of the day, the received PV is 1000, the pay PV is 750. In that case, it's a positive NPV. The NPV of the swap is the valuation of the swap is positive, which means you have earned from the deal. Okay. Swap counterparties face two main risks. One is market risk and another is credit risk. So now, since these contracts are over the counter, there is no exchange as such. Okay, there is counterparty. One counterparty gets into a contract with the another counterparty. So that's how the contracts are being. So hope the valuation or the NPV is kind of clear to you. They face two main types of risks, market risk and credit risk. So for when we look at each of the risks, so market risk is with the risk with regards to these payments. तो यहाँ पे सब पेमेंट्स हो रहे हैं ना, रिसीव लेग पे जितने भी पेमेंट्स है ना, ये सब मार्केट वेरिएबल्स पर डिपेंड करते हैं, लाइक इंटरेस्ट रेट्स एंड अदर वेरिएबल्स हम लोग देखेंगे इन डिटेल। करेंसी स्वॉप्स एंड इंटरेस्ट रेट स्वॉप्स हम लोग देखेंगे, तो करेंसी एक्सचेंज रेट इंटरेस्ट रेट्स वो सब पे डिपेंडेंट होते हैं। तो ऑटोमेटिकली मार्केट अगर तुम्हारे अगेंस्ट मूव कर रहा है, सो देयर इज अ मार्केट रिस्क विद रिगार्ड्स टू द सेम। एंड क्रेडिट रिस्क इज बिकॉज कि ये ओवर द काउंटर मार्केट्स है। एंड ओवर द काउंटर मार्केट्स इन द सेंस कि तुम्हें डायरेक्टली एक काउंटर पार्टी से डील करना है। यू हैव टू डील विथ अ काउंटर पार्टी, एंड इन दैट केस द काउंटर पार्टी माइट डिफॉल्ट। ओके, if the counterparty defaults, if they do not make the required payments to you, then in that case there are chances that you will, even if you are a positive NPV, even if this receive minus pay is positive, you have to take money from the counterparty, or the counterparty is bankrupt. So that's why there is a credit risk as well, which comes into picture. So yeah, both market and credit risks are faced by swap counterparties. I'll move on to interest rate swaps. Um, Fixed rate and float rate interest rates are generally exchanged. So now I'll tell you what does it happen. This is party A. This is party B. Party A will pay 6%. This is just dummy example. Huh? Numbers are dummy. 6% is dummy. 6% interest rate to party B, and party B will pay float rate or the LIBOR rate. Okay, float rate या LIBOR rate. LIBOR मैं लिख लेता हूँ। और अगर कभी कभी लाइबोर प्लस एक स्प्रेड रहता है, प्लस समझो 1% स्प्रेड, तो मतलब अगर लाइबोर रेट फ्लोट रेट तुम्हारा 4% है, तो 4 + 1 5%, फिर वो फ्लोट रेट समझो 7% हो गया, तो 7 + 1 8%। सो ऐसा पेमेंट होते जाएगा। दिस फ्लोट रेट विल कीप चेंजिंग, यू नो दैट बिकॉज इट इज फ्लोट रेट, राइट? दिस फ्लोट रेट विल कीप चेंजिंग। तो बी के पेमेंट्स, बी जो ए को देता है पेमेंट्स, वो चेंज होते जाएंगे, एंड ए को तो 6% ही भरना है। सो व्हाट डज, इसका यूज क्या है? आई जस्ट ऑल्सो मेंशन द यूज। यूज तो नेक्स्ट स्लाइड पे लिखा हुआ है, बट मैं स्टिल यहाँ पे मेंशन कर देता हूँ। अगर ए, ओके, ए के पास फ्लोटिंग लायबिलिटीज है, ओके, ए की जो लायबिलिटीज है यहाँ पे हम लोग लिखेंगे, ए की लायबिलिटी ये है फ्लोट बेस्ड, ये है फ्लोट बेस, मैं FL लिख रहा हूँ यहाँ पे। तो उसको जो भी फ्लोट पेमेंट्स आएगा वो सीधा वो लायबिलिटी को पे कर देगा, राइट? उसकी अगर लायबिलिटी फ्लोटिंग रेट है, उसका समझो ए ने फ्लोटिंग रेट लोन लिया हुआ है, कोई भी एक फ्लोट रेट लोन लिया हुआ है, तो हर बार उसका इंटरेस्ट पेमेंट अप एंड डाउन हो जाएगा। अभी ए को लग रहा है कि नहीं नहीं यार, इतना अप एंड डाउन इट्स नॉट गुड, सो ए विल गेट इनटू अ स्वैप एग्रीमेंट वेयर ए विल पे फिक्स, वो 6% ही पे करेगा, हर हर पीरियड में वो 6% पे करेगा, एंड उसको वो फ्लोट मिलता जाएगा रेट, एंड वो फ्लोट रेट वो लायबिलिटीज को पे ऑफ कर देगा। ये इंटरेस्ट रेट किस पे होता है? एक है ना नोशनल रहेगा, एक प्रिंसिपल अमाउंट रहेगा, लेट्स से $100 million एक प्रिंसिपल है, तो उस पे 6% एंड उस पे ये इतना अमाउंट। तो दिस इज हाउ इट वर्क्स। तो अगर तुम्हारे लायबिलिटीज फ्लोट रेट है, उन लायबिलिटीज को तुम्हें फिक्स्ड रेट लायबिलिटीज में कन्वर्ट करना है, तो तुम ऐसे कर सकते हो। अभी तुम्हारा लायबिलिटी क्या है? फिक्स्ड रेट पे करो इस पे, बस तुम्हारा लायबिलिटी यही है। बी के सामने से जो भी पेमेंट आएगा वो तुम इधर पे कर दोगे, तो ये तुम्हारा मीट हो जाएगा। तो योर लायबिलिटी इज जस्ट 6% फिक्स। सो बेसिकली पहले जो तुम्हारे फ्लोट रेट लायबिलिटीज थी, तुमने उसको कन्वर्ट कर दिया टू अ फिक्स्ड रेट लायबिलिटी, सो नाउ योर लायबिलिटी इज 6% फिक्स्ड रेट. सो दिस इज हाउ इट वर्क्स. एंड ऑल्सो एक चीज और देख सकते हैं, अगर तुम्हारे एसेट्स, ओके तुम्हारे एसेट्स, ये एक लायबिलिटीज के पॉइंट ऑफ व्यू से हो गया. आई प्रोबेबली नॉट रिमूव दिस. अभी मैं कलर चेंज करके टाइप करूंगा तो यू कैन अंडरस्टैंड. अगर इसके एसेट्स है ए के, सारे फिक्स्ड एसेट्स ही है, ओके सारे फिक्स्ड ही है. एंड वो फिक्स्ड एसेट सब फिक्स्ड रेट ऑफ इंटरेस्ट लेते हैं, ओके सब फिक्स्ड रेट ऑफ इंटरेस्ट लेते हैं वो फिक्स्ड एसेट. इन दैट केस व्हाट विल हैपन इज कि फिक्स्ड रेट का इंटरेस्ट आ रहा है तुम्हें हर एक इसमें 6% का फिक्स्ड रेट या 7% का तुम्हें एसेट से फिक्स्ड रेट आ रहा है. समझो 60% आ रहा है. समझो 6% इज व्हाट यू आर अर्निंग. ओके 6% इज व्हाट यू आर अर्निंग. यू कीप ऑन अर्निंग एंड देन यू आर पेइंग दिस 6% टू बी. बी तुम्हें फ्लोट दे रहा है. तो मतलब तुमने क्या किया, तुम्हारे जो फिक्स्ड रेट एसेट्स थे तुमने उनको कन्वर्ट करके फ्लोट रेट एसेट्स बना दिए. राइट. तुम्हें फिक्स्ड रेट एसेट्स थे, तुम्हारे एसेट्स तुमने बॉन्ड्स में इन्वेस्ट कर रखा है. दीज एसेट्स आर पेइंग यू 6% फिक्स. वो 6% तुम बी को दे रहे हो और बी तुम्हें फ्लोट दे रहा है. So automatically, what did you do is you ended up converting your fixed rate asset into a float rate asset. ये केस में हम लोग ने एक फ्लोट रेट लायबिलिटी को फिक्स्ड रेट लायबिलिटी में कन्वर्ट किया. ये दूसरे केस में, रेड वाले केस में, हम लोग ने एक फिक्स्ड रेट एसेट को फ्लोट रेट लायबिलिटी में कन्वर्ट किया. So this is how a swap works. You are swapping your interest rate. You are swapping your what you have. You are giving it to party B, and what you don't have, you are receiving it from party B. So this is kind of the swap, and it's based on interest rate. If it's based on interest rate, then it is known as interest rate swaps. So yeah. Hope your interest rate swaps is clear to you. I'll move on to the currency swaps. Okay. So here we have mentioned fixed and float rate can be exchanged. They are based in the same currency. Okay. Here, when I wrote down $100 million, it was dollar for both the currencies. So if you are paying fixed, this is what you will be paying. And if you are paying LIBOR plus whatever rate, float rate, suppose that float rate is 4.5 plus 1%. So you will be paying 5.5%. Everything on this particular notional amount only. So it's just the same currency, and company paying 6% fixed rate in exchange for a 3M LIBOR rate, plus 2% spread on a notional of 1 million for 5 years. This is just an example. 6% fixed rate is what you are paying in exchange of LIBOR 3M rate plus 2%. Okay, in this example, it's 2%. You can use any spread. So that spread, how to compute and everything, it's very depth into the risk management. We are not going so much, but in the question they'll mention it to you. It's the spread on a notional of $1 million for 5 years. It will happen till 5 years. So yeah, and company can hedge its float rate liabilities using a fixed rate. So company can hedge this float rate liabilities, all the whatever float rate liabilities it has, and convert into fixed rate. And similarly, it can convert its fixed rate assets. Okay, convert its fixed rate assets into floating rate assets. Convert its fixed rate FR, fixed rate asset into float. Okay, into float, into FL. So yeah, I'll move on. Moving on to currency swaps. So currency swaps is almost same as interest rate swaps. However, the main difference is the currency for both the notional payments is completely different. Okay, the currency is different altogether. So here in this example, 6% fixed rate on 80 million INR. Okay, 80 million INR is 8 crore. 80 million INR is 8 crore. INR पे 6% फिक्स्ड रेट. और जो लाइबॉर 3M प्लस 2% है ना, वो यूएसडी रेट पे. ओके, INR रेट पे नहीं, वो यूएसडी रेट पे. सो यूएसडी नोशनल इज 1 मिलियन. तुम कन्वर्शन देखोगे ना, तो जो नोशनल रहेंगे ना, नोशनल यहाँ पे $1 मिलियन है, एंड यहाँ पे 88 करोड़ INR है. सो तुम देखोगे ना, द एक्सचेंज रेट इज 80। मतलब जिस टाइम पे ये डील अग्री होगा ना, वो टाइम पे जो एक्सचेंज रेट है ना, दोनों नोशनल बेसिकली इक्वल ही होंगे। दिस 8 मिलियन इज इक्वल टू दिस 80 मिलियन, सॉरी, दिस 8 करोड़ is equal to 1 million US dollars. So this is how it works. तो नोशनल अगर हम लोग कन्वर्ट करके रखें, तो नोशनल इज घूम फिर के सेम ही, नोशनल तो सेम ही है, कन्वर्जन सिर्फ बट अलग अलग करेंसी पे है। तो अभी तुम इंटरेस्ट रेट तुम उसको पे करोगे, वो तुम INR में पे करोगे, राइट। तुम जो 6% पे करोगे, दैट इज 6% इंटू 8 करोड़, और ये सब होगा INR में, तुम INR का पेमेंट दोगे, और तुम्हें मिलेगा 3%, लाइबॉर 3M प्लस 2% ऑन 1 मिलियन US डॉलर। तो तुम्हें USD के पेमेंट्स मिलेंगे, और तुम पे करोगे INR का। सो या दैट इज जस्ट अनदर थिंग दैट इज डिफरेंट। And interest rate used to discount both these legs would be based on the respective currency। मतलब जो अलग अलग करेंसी है, तुम्हारा रिस्पेक्टिव करेंसी है, उन पे ये तुम्हारे इंटरेस्ट रेट बेस्ड होंगे, राइट। तो इन दिस केस अगेन यूएसडी लेग को डिस्काउंट करने के लिए यूएसडी रेट, आईएनआर लेग को डिस्काउंट करने के लिए आईएनआर रेट। यू कैन discount both the legs using same interest rate, right? That completely makes sense. So अलग अलग रेट पे अलग अलग करेंसी का डिस्काउंटिंग अलग रेट से होगा। कैपिटल पेमेंट्स ऑल्सो हैपन एट द स्टार्ट एंड एंड ऑफ द कॉन्ट्रैक्ट। मतलब क्या होगा कि तुम पे कर रही हो 80 मिलियन, तो स्टार्ट में तुम 80 मिलियन पे करोगे, एंड तुम्हें 1 मिलियन US डॉलर्स मिलेगा। ये होगा कॉन्ट्रैक्ट के स्टार्ट में। कॉन्ट्रैक्ट के एंड में एग्जैक्टली ऑपोजिट, तुम्हें 80 मिलियन मिलेगा एंड तुम 1 मिलियन डॉलर्स पे करोगे। वन। सो दिस इज व्हाट विल हैपन एग्जैक्टली एट द एंड। तो ये कैपिटल पेमेंट्स स्टार्ट में होंगे और एंड में होंगे। स्टार्ट में जो हुआ उसका एग्जैक्टली ऑपोजिट एंड में होगा, एंड दैट विल वेरी नलिफाई आउट। बट एंड में यहाँ पे एक्सचेंज रेट कुछ अलग हो सकता है, राइट। यहाँ पे स्टार्ट में तो एक्सचेंज रेट 80 है, तो ये इक्वल एक्सचेंज है। बट एंड में अगर एक्सचेंज रेट 90 हो गया, तो तुम बेसिकली अर्न कर रहे हो, राइट, बिकॉज तुम्हें सिर्फ पे करना है 80, बट एक्चुअली ये 1 मिलियन का वर्थ है 90, राइट। सो दिस इज व्हाट बेसिकली, कि तुम्हें यहाँ पे इंटरेस्ट रेट से तो प्रॉफिट होता ही है, तुम्हें करेंसी कन्वर्जन से भी प्रॉफिट होता है इससे। दैट्स व्हाई इट्स द करेंसी स्वैप। तुम करेंसी भी हेज कर सकते हो, करेंसी रिस्क कैन ऑल्सो बी हेज विद दिस। So yeah, company would pay 80 million INR at the start of the contract and would receive 1 million at the start of the contract. हाँ, and this would be exactly reversed at the end. So ये exactly सब कुछ reverse हो जाएगा जैसे हम लोग ने देखा। But ये जो reverse होगा वो 5 years के बाद होगा, right? So in that case, probably currency exchange rates will change and you will earn from that as well. तो यार इट्स बेसिकली कि तुम अगर ये कौन सी कंपनीज करती है, मैं उनका भी एग्जांपल दे देता हूँ। अगर दिस हैपन, इफ यू आर एंड सपोज यू आर इंडियन कंपनी, यू आर TCS, तुम इंडियन कंपनी हो। रुको, मैं ना एक काम करता हूँ, आई विल जस्ट ओपन अ पेन, एंड इस पे ही मैं एक बार दिखा देता हूँ तुम्हें। लेट मी शेयर द स्क्रीन, आई एम नॉट श्योर इट्स विजिबल टू यू। या, इज इट विजिबल? ओके। हाँ। तो अभी यहाँ पे दिस इज TCS, आई राइट हियर TCS इंडियन कंपनी। TCS वांट्स टू सेट अप इट्स ऑफिस इन यूके। हाँ, TCS इज इंडियन कंपनी, उसको यूके में ऑफिस सेटअप करना है। एंड यूके की कोई कंपनी लेते हैं, लेट्स से बार्कलेज लेते हैं, ओके। बार्कलेज बैंक इज अ यूके कंपनी, उसको इंडिया में सेटअप करना है, राइट। उसको इंडिया में सेटअप करना है अपना ऑफिस। एंड what happens is कि if we look at TCS, it's an Indian company, Indian banks. Okay, TCS wants to set up in UK. So whenever you are setting up some new what do we say? Okay, okay. What I can do is I can just say the whole thing in English once. Start right from the scratch, because this is something new. So cross currency swaps is what we are looking at. I'll start with an Indian company. Indian company is TCS, and I'll start with a TCS and a UK based company, UK based company, UK based company, Barclays Bank. So now TCS wants to set its presence, like it wants to expand into UK, and Barclays Bank wants to expand into India. Okay, that is their plan. Here I'll write an intermediary. Intermediary. Okay. वो ठीक है अभी. Now, or else let's just not confuse ourselves with the intermediary. Let's just keep it simple. And now what will happen is, see, whenever you are setting it overseas, setting abroad, setting your business abroad, you will need to take out loan, right? It's not necessary that you have all your money already. And whenever you take out a loan, since TCS is setting its office in UK, since it is based in UK, what it will try to do is match the assets and liabilities, match the currency of its assets and liabilities, basically inflows and outflows, positive payments and negative payments, all the currency. So CTCS is setting its office in UK and it will start earning UK pounds, right? So if it takes a loan from Indian bank, then it is difficult, right? Liability is INR and your assets are coming in GBP, so that will still lead to kind of currency mismatch. So what will TCS do is TCS will take out a loan from Indian bank. Okay, and Indian banks, they know TCS. I'll just write here Indian bank, and Indian bank loans. It suppose it gives a TCS loan at 8% because Indian banks know TCS, it's a reputed company, they'll get it at 8%. Similarly, if TCS had to take a loan from UK TCS, they'll charge probably 5% on the UK pounds. Okay, this is UK ka interest rate. They will charge higher interest rate to TCS because they don't know TCS. So they'll charge higher interest rate. Now, similarly, we'll look at here from the Barclays perspective. Barclays wants to set business in India. Okay. So now even they'll want to do the same thing, match positive and negative INR payments, right? So again, Barclays needs to take out a loan to set up in India, and that loan should be in INR, right? If it takes out a loan from its own domestic country, if it takes out a loan in GBP, and if it earns in INR, then again you need to pay all the EMIs in GBP. You are earning in INR, so there'll be all this currency conversion issues, and you will end up making loss, and there is so much of a currency risk that you will be facing. So what Barclays will do is but however, if Barclays takes a loan from India, Indian companies give loan to TCS at 8%. But the same thing, if they want to give it to Barclays, they'll give it at 10% because they don't know Barclays Bank. Right? Because they don't know is they'll know. But since Barclays would be more riskier, since it's a foreign company, right? Who knows that the company will take the money and run away? So Indian banks, this black thing which is there, I'll just keep this black thing. It's borrowing in INR. Okay, this is borrowing in INR. This black thing is borrowing in INR. Okay, borrowing in INR. So now automatically you can see TCS, it has the advantage to borrow in INR, but this Barclays does not have an advantage to borrow in INR. That is one thing. Now, again, TCS would want to buy or borrow it from UK. If TCS borrows it from UK, I'll just change the color and write it out here. If TCS borrows it from UK banks will ask TCS to pay, let's say, 5% interest rate on the loans. In UK, the loan rates are a bit lesser than India. So, yeah. And if Barclays asks for a loan, they'll suppose give it to them in 3.5%. Again, you know the reason, because UK banks, UK locals, they know Barclays Bank, they'll give them loan at 3.5%. UK people don't know TCS. They'll think that who knows, TCS will take the money and go away. So they'll not give you the loan at 3.5%. They'll give you a loan at 5%. So you know now what is the advantage, what is the disadvantage. TCS has the advantage to borrow in INR at 8%, but it wants to borrow in GBP, right, to match the GBP income. TCS can borrow in INR easily at a good rate, but it actually wants to borrow in GBP at a good rate, but it's not getting a good rate in GBP because it's new to UK. Similarly, Barclays can borrow easily in from UK markets at a very good rate, but it wants to borrow from INR Indian markets because it wants to match its assets and liabilities, right? If you are setting business in India, then you will be earning in INR, and automatically you ensure that your liabilities are also in INR so that you match those. There is no currency risk. This is what your plan should be. So Barclays wants to borrow in INR, but it is very costly. It's 10%, and for TCS, it's very costly in GBP. So what they'll do is they'll meet. So here in the earlier part I wrote an intermediary here. So intermediary, you can take example of any other big bank, probably JP Morgan Chase. They both will move. They'll both will reach out to JPMC, and JPMC will ensure that the deal happens, and it will take a small commission from both the parties. That is what happens in reality. But not to make this a little bit more complex, I am removing the intermediary altogether, and we are assuming that both the banks, both the counterparties, they deal with each other directly. So now what TCS will do is TCS will take out a loan in INR. Okay, TCS will take out a loan in INR because it is easy for TCS to pay in INR. So it will take out a loan in INR, and it will ask Barclays to pay TCS 8%. Okay, here we are not looking at profit losses and everything. 8% on a notional amount would be decided. How much notional both the companies want? Both the companies want how much loan? If TCS suppose wants a 1 billion pounds loan, okay, 1 billion pounds. This is 1 billion pounds loan if TCS wants, and automatically then Barclays would be like 1 billion pounds is, I'll just write in terms of crores so it's clear to you. It's 100 crore pounds is what TCS wants the loan for, and Barclays also wants it for the same amount, but Barclays wants it in INR, so we'll convert it into INR. Assume the exchange rate is exactly 100. I'll just write out here the exchange rate being 100. GBP INR is 100. Okay, so 1 GBP is equal to 100 INR, and this is how the notionals look like. So now, Barclays will pay 8%. I'll just again move to thing. Barclays will pay 8% this notional, on this 10,000 crore notional to TCS on an annual, periodic, whatever basis is. This is how Barclays will pay, and TCS will pay it back to its bank. Right? TCS has taken a loan from an Indian bank. Suppose HDFC Bank, TCS has taken a loan from an Indian bank at 8% on this 10,000 crore amount. Now, the responsibility to pay that loan does not lie with TCS, it lies with Barclays Bank. Barclays Bank will completely ensure that this 8% loan is being paid at this particular notional. Why does it do it now? Because what happens is Barclays, remember, Barclays had to take out a loan from India. It had to take out a loan in INR, but it was getting 10%. That is not favorable for Barclays. So it reached out to TCS and said to TCS, you take a loan on 10,000 crores because you will get it at 8%. So you take out a loan, give the money to me, and I'll do all the EMI payments and all the loan repayments. Okay. So understood this point. So TCS took out a loan at 8%. Now Barclays is doing all the payments at 8%, everything in INR, and it got a benefit. If Barclays directly would have taken a loan, it would have gotten it at 10%, but now it's getting at 8% because it took a help of TCS. Again, TCS also needs help. Favor is done on both sides, right? So TCS also needs help. So what will TCS do is TCS will pay off the loan which Barclays has taken. Barclays has taken a loan at 3.5%. So 3.5% is what TCS will pay on how much? 100 crore pounds. So now TCS is also at benefit. If TCS would have directly taken a loan at 5%, that this would have been expensive. This is so much expensive, right? You don't want 5%. So it now got 3.5% on 100 crore. So now TCS is making all the payments to Barclays. Basically, it's kind of paying off the loan which Barclays took from its own domestic bank. So Barclays took it from a local UK bank at 3.5% on 100 crore pounds. So that TCS is helping it to pay. So now in case of TCS, what the liability is? Liability of TCS. The end of the day, TCS has to pay this only. This loan Barclays will pay. So TCS only has to pay this now. And at the end, how much does Barclays have to pay? Only this 8% on the exact same notion in INR. Right. So the main purpose that they both came to fulfill is fulfilled. You got a loan, you got a currency conversion mainly. You got a currency conversion. You got to match your assets and liabilities. Your assets and liabilities are matched now, and you also got a desirable interest rate as well because of the help of the other counterparty. So with a desirable interest rate, you got a help and also you got a help of currency conversion. So this is kind of beneficial for both the parties. Hope this is clear to you. Here only in reality, what happens is an intermediary comes into picture and both the parties pay a small, like half a percent of the fees to the intermediary. And here we considered 3.5% fixed and 8% fixed, but this could be floating as well. So even that float, one party could pay fixed rate in INR and another party could pay float rate in GBP. So that fixed float difference can also arise. Here we assumed both as fixed just to ensure simplicity. So hope this is clear to you, this example. Even if it is not, it won't be asked in exam. It's just something that me specifically I work with a lot. I work with swaps a lot at Deloitte. So my out of if I look at my workplace, around 20% or 15 to 20% of my work generally is with to deal with swaps, pricing of these swaps, valuation pricing, then sensitivity analysis and all those things. So yeah, that's why I explained it a bit. And this is just a snippet which I created on Excel on a rough basis so that you can understand it in a bit better way with the cash flow. So these are just random examples of random notionals and everything. So I took a valuation date of 30th August. Receive fixed. So you are receiving fixed. You are receiving this fixed rate on a INR notional. So I used the exchange rate, and if you can see, the INR notional is almost this USD notional into the exchange rate. So this is it. And coupon cash flow. So what is the coupon cash flow? This notional N into the fixed rate, which is 4.34, into what the year frac is, basically into how many days are there between this period. So suppose if there are 175 days, so 175 upon 365, because it's not a full year, right? If it was a full year, then full 4.34 would have come into picture, but it's a half year, so half is coming into picture, and this is how coupon cash flow is computed. And it is discounted using a interest rate curve, not a simple interest rate, not a fixed interest rate like 5% discounted by 5%. It's discounted using the interest rate curve known as INR mod MIFOR. We won't go into much detail, and this is the PV of that particular swap. Again, when we look at pay float, so when we look at pay float, this is how the pay float works. The cash flow dates are same, notional is different, and this is a float rate, right? So this rate, see, you can see it keeps on changing. This lay rate is different, right? It is 2.1, and you are adding a spread. So when we say LIBOR 3M plus spread, this is LIBOR 3M, right? The one that is forward rate is LIBOR 3M, and this is a constant spread over and above this rate. So the final rate in the first case would be 3.11. You can just add both that. Is secondary, it would be 4.73 roughly, and third May it would be 4.29, right? And those will be the three final rates. And based on the rates, using the same formula, these coupons will be computed. And again, discount factor here, discounting is done using USD SOFR, which is a USD interest rate, and this is the final flow. This flow is in USD, the above flow is in INR. These both are PV, right? Present value. So now what we need to do is receive fixed. So INR PV minus USD PV into exchange rate, into FX rate or exchange rate. This is the cash rate or the exchange rate. You can multiply this USD PV by the exchange rate and subtract to get some final value. And this is the final value in INR. So basically, it's negative. Basically, it means that you are losing on the deal. That is what it means. So hope it is clear to you this example. Don't go into so much detail. It's just that I have created it on your own on a dummy number basis. But just that if it is in a form of numbers and tables, it is more clear. And this is a cross currency. Okay, it's not an interest rate swap. It's a cross currency interest rate swap. So currencies are also different, and interest rates are subsequently different. So yes. Hope this example is clear to you. Even if it is not, it's still okay. It's not that it will be asked in the exam as such, just to give a bit of a knowledge to you. And moving on to the uses of swaps. So this is what we already looked at. I've already explained it to you on that Paint notepad. So you can reduce risk by matching assets and liabilities. Currency of assets and liabilities can be matched with this. Basically, if you have liabilities linked to floating rates but fixed rate assets, then you can convert those fixed floating rate liabilities into fixed rate assets and be get a more matched position. Your position can be matched easily. So that is how you can work it out. Currency swaps could be used by a company with liabilities in one currency and assets in another. So like we took an example of TCS and Barclays Bank. So if you have a liability in one currency, so TCS would take a loan from India, right? TCS won't take a loan from UK because UK loans are expensive. TCS would take a loan from India, so it will have liabilities in INR, but assets in UK because it will keep earning UK pounds, right? So in that case, what you can do is you can use currency swaps and swap it out. It could also be used to reduce the cost of debt. We saw the example for TCS in UK, the cost of debt was 5%, but when it took the help of Barclays, it reduced to 3.5%, right? That in that example. Also, the cost of debt for Barclays in India was 10%, but when it took the help of TCS, it got reduced to 8%. So even that is another thing. And we know why this happens is because uh, one company has comparative advantage in borrowing a floating rate while another company has a comparative advantage in borrowing at fixed rate. So again, in that example, we took both fixed rates only. If you can also take floating rates as well. So in this example that I have mentioned out here in the last slide, here this is a fixed rate that you are receiving on a INR notional, and you are paying float rate on a USD notional. So this is a fixed float swap, fixed float cross currency swap. The example that I took in Paint was fixed cross currency swap. So that is the only kind of difference between both. And they can use the interest rate swap to reduce the cost of financing and benefit from lower cost of debt. So end of the day, cost of debt would be reduced. That is the benefit for both the companies. So hope this is clear to you. I don't think it's mentioned in so much detail, even in the course notes. But because again, it's the topic that I like a bit, so I thought why not explain it more in detail. So yeah, I explained it a little bit in detail with some examples given, so that it's completely clear to you and you don't have any doubts as such. Okay, so use of derivatives. This is what I'll move on to the course notes. This is the course notes. We started with financial futures, the definitions, four categories. We looked at what each category mean. We also looked at margins. So initial margin and variation margin is what we looked at with the example as well. Here also they have given example. Why margins are required. This also we just saw of some points. And we moved on to types of financial futures. Basically, the bond futures, short interest rate futures, currency futures, and stock index futures. We saw what they mean, and we also saw the uses of the same. So along with the uses, we also saw what they mean. So yeah, and this is the whole section on futures only. You can just read it, read the whole thing, not miss anything. There are small questions. These questions are just to enhance your knowledge as such. They won't be asked in the exam. Just that it's just something new. So just read it once and don't skip it. And all those things are, these are all examples and everything. And we took all the examples while explaining in the live lecture, but still have a read at it because it will be a bit different as well. So that might help. We looked at forwards. There was a specific slide on the differences between futures and forwards. So this is also what we had, seen it once. And we moved on to options. We saw call put option, American style option, European style options. Then we also saw the uses of these options for the companies along with the payoffs. So there are no payoff diagrams as such. This is a lot of short slide, but we saw it in more detail with the examples, with the profitability, payoffs, and everything. Then we moved on to interest rate and currency swaps in this lecture. And these are the risks. These are the two types of swaps. And finally, uses of swaps. And with this, we are done with this chapter. A very short chapter, I would say, roughly around 16, 15 pages chapter only. So, you can read it. It's not something very difficult. It's kind of easy. The questions are also easy. So once you are done watching the lecture, take your time. It will just take 1 hour for you to read those 15 pages and solve these questions. So do solve it, do complete it. And with this, we are done with chapter number 8. Thanks a lot for watching this lecture with me. If you have any doubts, please feel free to reach out to me on the group. Share your doubts. Just take a screenshot of it and share your doubts on the group so that, any one of you, anyone else who knows it, who knows the answer, they can solve it. Or if no one knows, or if no one is solving, I am always there to solve it. So put your doubts on the group. And yeah, done with 8th chapter. Thank you very much.